Hello and welcome. Today, we're taking a deep dive into one of India's electronics manufacturing giants, Dixon Technologies. They just dropped their Q1 results for fiscal year 26, and honestly, the numbers are pretty staggering. So let's get right into the data and figure out what's powering this company and what hurdles might be just around the corner. Okay, let's just start with the headline number that's got everyone talking. 95%. Let that sink in for a second. That is the year-over-year revenue growth Dixon just posted. It's an almost unbelievable figure, and it immediately makes you ask the question, how on earth are they doing? And this growth isn't just some vanity metric at the top. Sure, revenue rocketed to over 12,800 crore rupees. But look at the bottom line. The profit after tax, the actual cash in the bank, so to speak, literally doubled. A full 100% increase. This tells you they're not just getting bigger, they're getting more profitable on a truly massive scale. So that brings us to the core question we're going to tackle in this explainer. It's really a two-part puzzle, right? First, what's the engine behind this absolutely explosive performance? And second, the really important part, is that engine built for a short sprint or for a marathon? To figure that out, we're going to break it down. We'll look at the company's core strengths, we'll be honest about its weaknesses, then we'll explore the huge opportunities on the horizon, and finally, the potential threats. And then we'll put it all together to see what the final equation looks like. All right, so let's pop the hood and start with that engine. What are the fundamental strengths that are actually powering these incredible numbers? Because let's be real, this kind of performance doesn't just happen by luck. This whole operation is built on some truly incredible financial discipline. The return on equity is nearly 50%, which is just massive. But the number that really makes your jaw drop is a negative 4-day working capital cycle. Now, what in the world does that mean? In simple terms, it's like a business superpower. It means Dixon gets paid by its customers before it has to pay its own suppliers. Their suppliers are effectively financing their growth. That is a sign of immense power in the market. And that financial power, well, it translates directly into market dominance. They're now India's largest domestic mobile phone maker. In just a single year, they've grabbed about 10% of the refrigerator market. And their telecom segment, it's up over 250%. All of this comes back to their core strategy. They're not just assembling boxes anymore. They're building a deep, integrated ecosystem of components. And this isn't just some analyst theory. This comes straight from the top. The managing director, Atul Lal, says their confidence comes from this intense focus on backward integration. It's all about moving up the supply chain. Instead of just assembling the final phone, they're now aiming to make the screens, the cameras, the parts inside the phone. It's a classic strategy to own more of the value and build a much more defensible, future-ready business. But of course, no company is perfect, right? So let's flip the coin and look at the other side. Where are the cracks starting to show? Because even Dixon's own management is pretty upfront about the challenges they're facing. And here's the most obvious one. In a quarter filled with spectacular growth, the consumer electronics segment, which is mostly their TV business, actually went down a bit. Management didn't mince words. They called this a significant miss. It's a rare stumble in what was otherwise a home run quarter. And beyond TVs, you can see the growing pains. Their new camera module business, Q-Tech, is starting out with lower margins, around 6.5% to 7%. But maybe more importantly, management admits that their own bandwidth is stretched pretty thin, and that finding the right people, well, in their own words, their talent acquisition, has to be scaled much more just to keep up with their own ambition. So, how are they planning to fix these issues and keep the growth engine roaring? Well, this is where it gets really, really interesting. They're essentially building an entire electronics empire through a blitz of strategic partnerships. This right here, this is their backward integration strategy in action. Just look at this list. They're setting up an empire of joint ventures to control almost every part of the electronics manufacturing process. Mobile design with Longcheer, display modules with HKC, servers with Inventec, all the way down to critical bits and pieces like camera modules and precision parts. Every single partnership is another piece of a giant puzzle they're putting together. So what's the end game here? Why all these complicated deals?
Well, the MD, Atul Lal, he spells it out perfectly. He says these JVs are designed to secure their business for the post-PLI scenario. Now that PLI, the government's production-linked incentive scheme, it's been like rocket fuel for them, but it's temporary. Dixon knows this, and they're using this time to build a foundation that's strong enough to stand on its own long after those government incentives are gone.
And the prize they're chasing with this strategy, it is enormous. The company believes there's a potential export market for them of 11 to 12,000 crore rupees. Just to put that in perspective, that's up from only 1,600 crores last year. They're not just thinking about India anymore. They're gunning for global scale.
But as we all know, with great opportunity comes great risk. In trying to build an empire this fast, on a foundation of complex international partnerships, well, that creates a whole new set of threats they need to navigate. The biggest, darkest storm cloud on the horizon is definitely this PLI countdown. That government incentive scheme for mobile phones has been a massive tailwind, basically subsidizing a lot of this growth. But that scheme is set to end this fiscal year. Figuring out how to thrive in a post-PLI world is without a doubt Dixon's single biggest challenge. And it's not the only hurdle. Many of their most important joint ventures are with Chinese partners, and those require specific and sometimes very slow government approvals to move forward. On top of that, competition is absolutely fierce, which puts constant pressure on their profit margins. And as management themselves will tell you, the export business is just plain harder. It's more complex and has higher upfront costs.
Okay, so let's put all these pieces, the good, the bad, and the ambitious, together. How does this whole equation balance out in the near future? Let's see what the company itself is forecasting.
The company's own guidance shows a really clear two-step plan. For this year, fiscal 26, it's all about one thing: growth. Pure top-line growth of 40 to 45%, even if it means profit margins stay flat. But then, look at the pivot for fiscal 27, right after the PLI scheme ends. The focus shifts completely to profitability. They're guiding for a significant margin expansion, driven entirely by those new component businesses they're building. This big pivot is also going to fundamentally change the shape of their business. Right now, mobile is the undisputed king, making up about 80% of all their revenue. But starting next year, they expect their other segments, everything from refrigerators to IT hardware, to start carrying more of the weight. The goal is to create a much more balanced and resilient company. So, when you take a step back, Dixon is executing a breathtakingly ambitious strategy. They're transforming themselves from a simple assembler into a deeply integrated electronics powerhouse. The growth is undeniably real, and the opportunities are massive. But it all comes down to one final critical question. Can a company successfully manage an empire that it's building at lightning speed? Can they handle the sheer complexity of their own ambition? That's the real story to watch. Thanks for joining me.